don't take that vacation yet. You have to make sacrifices today to have a better life down the road.
To want the instant gratification and feel like, gosh, I deserve this. And I earned this. I've worked really hard, and all that's true. And it's expensive to live. Money just doesn't go as far as it used to.
Right. When you start a retirement plan, even at 18, it could be $50 a month, even something just as small as that, but at least you're starting something. Long end game is if you can be in a fund that's averaging 8 to 10% a year for life, you should get to those big goals that you have. They have to also get in the mindset of putting yourself first. When I talk to younger entrepreneurs, I say, do you want to pay yourself or do you want to pay the IRS?
Oh, snap. That's a real
Boom.
Welcome back to the Successful Stylist Academy podcast. I'm your host, Ambrosia Carrie, and I'm here with a very special guest. This is actually one of my clients, Carrie Scott, who is a financial planner with Cetera Investors. And we were talking at her previous appointment, and I was like, will you share just your wealth of knowledge with us, the stylist, the salon owner, the creative entrepreneur? And so I'm really eager to hear not just your background story, but just some tips that you might have for us creatives that, we're really good at generating money, but we're not great about reinvesting it back into our future and just really thinking about the landscape of our portfolio and what it can do for us and how our money can make money for us. So I am just so excited to hear from you. So first of all, Carrie, welcome.
Thank you.
I'm so glad that you are taking your time out of your busy schedule to hang out with us and share your knowledge. I would love to start with just hearing a little bit about your background story, because I know you have your bachelor and or you have your degree in marketing and you went to school for that. And what got you into investing to begin with?
It's kind of a crazy story. My parents had an advisor at a very big firm downtown Portland. And my junior year of college, that was something I was interested in. So I did an internship with them. And it's a little bit funny, and that's why I didn't say the name, because a couple things they had me do, like paying me under the table, are probably not legal. But I was interned there for 6 months, did a lot of cold calling, trying to get people to come to like estate planning seminars, that kind of thing for them. That's when I realized I don't want to be a stockbroker. I wanted to work more with mutual funds and work with the middle class people who are trying to better themselves over time. So that was kind of the first step in my long-term focus. And then the day after I graduated from University of Portland, I started working for First Investors at the time. And here we are, last week was 28 years anniversary of being in the business. So I think the passion for helping people achieve their goals. And now that I've been in the business for such a long time, watching someone who was 22 start investing with like $50 a month, and now they have kids going to college, and now they call me and have me send money to their bank to pay for college. And I'm doing that myself with my daughter. So it's a very fun thing to see people's progression over time.
Wow, that's cool. And now you're seeing like full circle moments where somebody started their investment and now they're paying it forward to their kids. And then
right.
With investing for your child's future and getting your child set up for their future successes, I've heard a couple of different scenarios, like one being like being a business owner and adding your child on to as an employee or their a W-2. Is that like a legal thing to do?
In most cases, they need to be 18 for them to start investing. So there are custodial accounts you can do where the parent's the owner. I have a few clients that have a Roth IRA for their 16-year-old, for example, but they have to have earned income of some kind to do that. So the legality of it, you need to talk to your CPA.
Okay.
But there are definitely plans that people can do for their kids, but they just have to have some kind of income or job in order to be able to add to those kind of like a Roth IRA, for example.
So while we're on the topic of creative entrepreneurs, we're going to call them, instead of it just being a hairstylist or salon owner, I think that we all kind of fit under that umbrella where, we use our creativity and our passion, we start to earn some money, and then we don't really know quite what to do with that. So One of the questions that I have is like, what is maybe the first step that someone should take toward managing their money, or how should they be thinking of their money even? I think there's like a mindset thing, and you and I talked about that a little bit too.
Yes, the thing I believe when you're a new owner or a self-employed person starting your own business, which we were, and I still am self-employed, is, looking at your budget from month to month. Once you feel that you have like a consistency, then it's like, how much can I use that I'm not using for product or the things I need for working with my clients to just set aside? And I feel like an emergency fund is kind of the first thing, not even investing, but just having. I mean, imagine if you're 22 or 18 and you've got five to $10,000 in savings. Like, I don't know anyone that had that when they were 18, or
Yeah, I
it's
know. I
rare.
didn't.
So having even like a few $1,000s that's just set aside for emergencies, I think is the first step. They have to also get in the mindset of putting yourself first. And so a lot of times, they've got bills to pay and they want to buy more product for their self-employed business, whatever it might be. What would happen if you put it first in your mind? I need to take care of myself. And I don't mean right
Mm,
now as in immediate gratification, because
mhm.
I feel like these kind of younger generations are all about immediate gratification.
Yeah.
I mean, thinking of mindset, I need to pay myself first.
Mm,
When you start a retirement plan, even at 18, it could be $50 a month, even
yeah.
something just as small as that, but at least you're starting something.
Right.
And
Yeah.
anything you do towards a retirement plan will be a tax deduction for your business. So when I talk to younger entrepreneurs, I say, do you want to pay yourself or do you want to pay the IRS?
Oh, snap. That's a
Boom.
really, yeah.
I'd rather pay myself
Period.
than them.
Exactly. Yeah. That's a good point of view. I mean, I think sometimes when we get caught up in the cycle of running our business, I think one of the really easy things to do is you're just focusing on what's next rather than thinking ahead on maybe setting things up. So I think it's the initial setting up thing that it feels intimidating, and therefore it's really easy to just not do it
Yeah.
and have it in the back of your mind. And that can just go on for years and years to come.
The
Yeah.
average age, so I work with a lot of teachers in
Hmm.
the school districts in Oregon, and the average age of somebody that actually starts, because yes, they have a pension with the state, but it's 40.
Oh, wow.
Imagine if
That
you
late.
started at 20.
Oh, man.
Yeah, it's crazy and it hasn't really changed because I've been doing this for a long time and it's
Yeah.
still about the same.
No way.
I was doing a class. I think I told you about that, like for my son's high school. Well, I used to do them out in Umatilla quite a bit for a leadership class,
Hmm.
and they would have me come out twice a year and talk to their juniors and seniors.
Hmm.
And that day, I was bringing lunch in for the staff because I have a lot of clients there. And I showed these kids, like 17, 18-year-olds.
Yeah.
I said, how much money do you want to have when you retire? And they said 1.5 million. So we use that as an example. Well, if you're 18 and starting investing, I showed them how with compound interest, you would only have to save like 110 to 125 a month
Hmm.
at 18 to have 1.5 million by the time you were 60. And they went back
Wow.
to their classes
Yeah.
and told their teachers, I'm going to be a millionaire. And then I had 8 teachers that day in the upper 30s, early 40s who said,
Yeah.
I've never invested on my own other than what the state does for me. I need to start an account with you.
Wow. That's,
So the kids were the ones that came back and said, I'm
yeah.
going to have more money than you, Mr. So and so.
Yeah.
And it was pretty powerful, I think.
Yeah. So it's more getting that big, broad picture, that final end result, like the big goal, and then how you need to work backwards from there, starting at your age and how
Right.
much you actually have to invest. We hear the word compounding quite a bit, but I think that people are nervous or scared to ask really what it is. Like, what is compounding? What does it mean?
It's a very powerful tool. Imagine adding $100 a month to an investment and you're getting interest on that every day. It could go up, it could go down. That's part of being in mutual funds or exchange traded funds because they're going to fluctuate all day long, right? But the long end game is if you can be in a fund that's averaging 8 to 10% a year
Yeah.
for life, you should get to those big goals that you have. So compounding interest is every day, if you see the stock market going up a tiny little bit each
Yeah.
day, and keep in mind it goes down too.
Yeah.
This year has been the wildest swings I've ever seen. But with compound interest, like if you add monthly to something,
hmm
you end up getting a lower price per share because the market's going like this all the time. So every month you're adding, you actually end up with a lower cost for the shares of a fund. And long term, that compound interest just keeps growing and growing and growing. So each year, you're now getting interest on a bigger pool. And then as time goes on, it keeps compounding. Does that make sense?
Yeah, I mean, the way I always envisioned this, and I don't even know if this is correct, is that you keep earning on the interest that keeps contributing to it. So the number as it grows, you keep earning interest on the number that's growing. It's not like a set
Right,
amount. Yeah.
right,
So it's kind of like snowballing into more and more and more.
right.
Okay.
And all my teachers, for example, if they are just putting in monthly
Yeah.
and the market falls 30% like it did during COVID, it was like 36% down in 6 weeks.
hmm
Well, they had two contributions go in at that time, buying at a 30% discount.
Mm,
And then the market came up since then, and now it's at the highest levels at last year at the end of the year that it's ever been at. So
interesting.
I like it when people add monthly because they get a lower price per share, which means they make more interest long term. And sometimes I think it's almost better than putting one big chunk in each year.
That actually answered one of my other questions because I have seen some people who, they'll contribute like the one once a year or they'll do it like quarterly or whatever. So you think it's better to mitigate that risk or spread it over time and just do a monthly installment?
Right.
Okay.
So that's where I would say if someone's not sure where to start,
hmm
start with 50 bucks a month or 100 bucks a month. You know you can do it. And then you have until usually April 15th at the end of the tax year from the
hmm
previous year to maximize the rest. Like, depending on the retirement plan, right? If it's an IRA, whether it's traditional, which you get a tax deduction, or a Roth, which is tax free later, you can put in 7,000 a year into it. So I have a lot of people that will do 100 a month because their income changes throughout the year, especially self-employed people,
hmm
and then they'll put in the rest later.
Oh,
Um,
interesting.
so it just that way because maybe summers are better for them and busier, and so they have more in the summer, but in the winter they don't.
Ooh, okay.
So like
So yeah.
construction or like there's a
Yeah.
lot of
Like if
different,
your income's fluctuating, you kind of
right,
just adjust it accordingly.
right. So I say
Ah.
still do something, even if it's smaller monthly, and we can catch it up at different times throughout the year when you're actually having a good year or a good part of the year.
Okay, cool. Maybe while we're on that note, I would love to hear from you. Like if you've seen some common things that are maybe like the top three mistakes that you see creative businesses that make when they first start earning some income, or maybe they're either not investing or they're investing in the wrong thing. Or I think these days with TikTok and Instagram, there's just a lot of noise and there's a lot of advice being given. There's a lot of like the get rich quick kind of scheme type stuff. So I would love to hear from you just maybe some of the most common financial mistakes that you see self-employed creatives make, because I think that that's like a really big one right now.
Yeah. Number one, they don't put themselves first. And that's what I mean by saying, do you want to pay yourself or the IRS? That to me is the biggest thing. Put yourself first and get that mindset of the first thing I do is I take this $100 or this $1,000 and put it into an investment.
Yeah.
Whether it's just short term, an intermediate, or a long term, doesn't matter. I don't care what it is, get something in there. The second thing I would say is they incur way too much debt.
Yeah.
And I feel like the debt in kind of these younger generations is a huge deal. And
Yeah.
so that's another thing I teach to the high schoolers because I was in that position too when I was in college. And
Okay.
I had a bunch of debt that I had. How much more could you have at 22 if you weren't paying off a bunch of credit cards and
Yeah.
things
Right.
like that?
Yeah.
So, trying to find a way to still keep your business running, but not incur too much debt. Don't take that vacation yet. You know
Yeah.
what I mean? Like you have to make sacrifices today to have a better life down the road. And I think that's that immediate gratification thing that people are really focused on right now that they need
Yes.
to put aside.
Right. I know. You just got to get scrappy. I think being clever and just coming up with creative ways to spend money or vacations that won't break the bank or just ways that you can, yeah, I think get innovative about it because it's not always going to be that way. But I think that's
Yeah.
great advice because I think it's really easy to want the instant gratification and feel like, gosh, I deserve this. And I earned this. I've worked really hard and all that's true. And it's expensive to live and like money just doesn't go as far as it used to. And
Right.
so I think just being smart with it, it's going to help set you up for the future. So that's really good advice.
It's this, do you want to sacrifice now or do you
Mm.
want to sacrifice when you're 60?
Ugh. Yeah, I
No.
know. I know. And when I see elder people like around even my grandmother's age, like people that are probably not that old, but maybe, like in the 80s and like late in their working jobs that are labor jobs. That's
Right.
just like, they didn't get there by accident. They probably didn't get there because they enjoyed doing it. I mean, I could be wrong, but I'm assuming that they got there because something went terribly wrong in their youth.
And they didn't have the education
Right.
either,
Yeah.
right? I mean, it's great I had an internship and that taught me a lot, but
Yeah.
I really didn't get an education on how to invest or,
Gosh, I know.
save
None of us
money.
did.
I spent everything when I was 18 or
Totally.
whatever.
Yeah. I know. I mean, it's fun.
Right.
It's addictive. It's hard. I mean, that's what we do, especially when we all hang out with the same age bracket and stuff. It's like, it's really easy. We want to be included and like our friends are drinking, we want to drink. Our friends are going out, we want to go out. So,
Yeah.
yeah, it's really tricky. I know. But also it's really good advice. Just like, do you want to have the pain now or do you want to have the pain later? I mean, that's just like the big question.
Yes.
This is the thing that I really don't understand when I hear like ETFs and index funds and like when we're talking about like these bigger, I don't know, like different categories of investment types. That's the part where I get a little glossy-eyed. So I'm hoping that maybe you can kind of break it apart a little bit for us so that we understand the difference between what is an index fund, first of all, and what is an ETF.
They're actually really the same.
Oh, okay. See, that's what I'm
And there are
what is it?
index mutual funds, there are index ETFs. There are
Okay.
regular ETFs. If it says index and it's like a S&P 500,
Yeah.
that means the money that you have in there is actually split between all 500 companies,
Okay.
right? So let me give you even easier example. Like, doesn't matter if it's ETF or mutual fund. ETFs trade like stocks and their costs are less, that's why people use them over mutual funds, but they're not that different really.
Oh, okay.
Mutual funds are more managed by a company like Vanguard has index funds and ETFs and mutual funds.
Okay.
So, and then it's just really the fee structure is what's different
Hmm.
overall. But when you explain what a mutual fund is, imagine a bubble or a ball. And inside that ball, there's 250 stocks or
Hmm.
bonds, because there's bond funds too.
Hmm.
Um, and you put $1,000 in there. That $1,000 is being split between all 250 companies in there.
Hmm.
So let's say there's IBM and Apple and Google and Tesla and Coke and
Yeah.
right. And all of a sudden, Tesla goes bankrupt. Maybe there was only $3 of the 1,000 in Tesla. So you only lost that $3. Now, if you go over here and put $1,000 in just Tesla stock and
Yeah.
they go bankrupt, what happens?
You lose all that money. It's
Gone.
gone. Yeah.
So when people say, I don't know what to invest in or what should I do, and should I go
Yeah.
on Robinhood?
Oh, yeah.
No. Just by putting in 50 or $100 a month or $1,000 into even just one mutual fund or ETF, your money is split between those 200 to 500 companies. So your risk is less, even going with a more aggressive fund.
That makes sense. That was a great way of explaining it. The bubble
I've
method.
been drawing that picture on a legal pad for 28 years for everybody because they don't really understand what it means.
So when it comes back to independent businesses, independent stylists, independent salon owners, what would you recommend? Because obviously, like when you're an employee, then you've got a W-2 and you've got different options for what you can invest in
Mhm.
versus when you're independent. What kind of plans would you recommend for the independent versus someone who is an employer?
So if you're W-2, a lot of those companies have 401ks, or maybe it's a smaller business, so they might have a simple IRA. So when I mentioned earlier, like traditional IRA or Roth, so if someone isn't making a whole lot yet, maybe they don't want to have a simple or a SEP IRA or one of these other kind of bigger, more comprehensive plans. They can just add 7,000 a year into a traditional IRA and get a tax deduction. But
Okay.
there's income levels. So if you make
Mm,
too much, then you can't write it off. So, and the Roth IRA, like I said, is tax, it's not a tax break now, it gives you tax break later.
later. Yeah.
The simple IRA, the most you can put into that is 16,500 this year in 2025, if you're under 50. So that I have used a lot for small businesses where they might only have like 5 to 10 employees. Maybe
Mm,
there's only even two or three
yeah.
because there's no cost to set those up. And they're
Oh.
very they're simple plans,
That's
simple
what I had set
IRA.
up at my other salon. We had a
Yeah,
simple IRA. Yeah.
yeah. Um, a SEP IRA would be like a solo practitioner, right? So when I was new in my business, it was just me. I was a solo person.
Hmm.
And now the SEP IRA contribution limits, it's 70,000 this year.
Hmm.
So if you're making a lot more, you can dump in a lot more to those. Um,
Are there,
and
what are the restrictions for a SEP IRA?
I mean, the thing is, with a simple and a SEP, you have matching. So
Okay.
if you have like if you have two employees and it's you, the owner, and then one other stylist, let's say,
Yes.
and they're under your plan,
Yeah.
if you put in, so it's 70,000 or 25%. So if they made 100,000, they could only do 25,000. They can't
I
do
see.
70.
Oh,
But if
interesting.
you, the owner, put in 25% of yours, you have to match for them. And the employee's not adding themselves to the step, it's just the owner. So that's why I say solo practitioner, because really the only people that do them are just a one man band, let's say.
Oh, okay. So for me, independent, if I had a SEP IRA, I could put in 25% of my income
Right.
and then
Up
the
to
business matches
70,000.
up to 70,000. Okay, got it.
Right.
And then the business
There's
has to match it?
no,
Oh, no.
it's just you.
Oh,
But if you
okay.
had an employee, then you have to match the same 25%.
Yikes.
And that's why most
Okay.
people don't do those unless it's just
Just
one.
them. Oh.
The simple IRA, it's like 16.5 is what you
Hmm.
can put in as the employee or the owner,
Hmm.
either way. But if one person says I'm going to do $50 a month and then the employer has to match up to 2%.
Okay.
So it just depends on the situation. It's a little more complicated,
Yeah.
but for small businesses that don't want to just pay 25% of someone's payroll,
Yeah.
the simple plan is kind of more designed for that.
Yeah. Okay. Yeah, the simple plan, it was really interesting too, because when we had a meeting with the staff, we were talking about, we're really encouraging them to at least put the minimum of 3% because we did the
Right.
3% match.
Yes.
But there was only one employee that was maxing out. To me, I couldn't understand why. given this option, they would not want to max out every time. But I just wonder if there is a lack of understanding around that, or because I think sometimes it's really easy to think that you can only afford X, but it's really interesting that when you have that amount missing from your account, or you just pretend that you don't make it, how you will be just fine without it. It's crazy. Like if you have like $300 less going into your account, you could say, I cannot minimize anything else. You will find ways. You will
You
be
will.
able to.
The other thing too is you might say, I'm going to be putting 300 a month in. It's not really 300. That because you're saving probably 80 to $100 of that 300 in taxes. So your check really only feels like 200 less, even though you're putting in 300.
Right, because you're reducing your taxable income. Because it's
Right.
like on paper, you look like you didn't make that much because you put it into
Right.
your investments and then that doesn't count until you pull it out.
So, like some of my teachers that are getting close to retirement and they're able to put in the maximum. So, that if they're over 50, it's 31,500 a year into their 403B, which we're not talking about, but it's like a 401k. It's like, anyway, they're all the same. Uh, but they ask me, like, oh, I can't put in 2,500 a month. I'm like, yes, you can. You're only going to see your check drop by 1,600. And they're like, oh, okay. So sometimes I'll actually say, how much actually do you feel like saving? If they
Yeah.
say 300 a month, I'm gonna like, great, we're gonna do 450. And then you
Mm,
might only notice three. Like I bump it
wow.
up the other way,
Yeah.
basically.
Yeah. Gosh, that's such a, oh man, it's so, maybe I think when people are thinking on those terms, are thinking about their gross instead of net. Maybe
Yes.
that's part of it.
Yep.
And then they also don't think about the money that will accrue during the time that it is sitting in the account. They just think of it as it's like a regular savings account or something.
Yeah.
Oh, okay. Um, so let's see. I think also I wanted to hear from you, like what your recommendation is for like the minimum amount. Like I know that it can vary depending on the person and their financial situation,
Yeah.
but what advice do you have for them? Like, is there a percentage that they should consider just putting in, or because I think that people will, they're like, oh, I'm saving X, but it's like, if you're only saving this much, will it make enough of a difference? Like, do you think any amount matters, or does it have to be like a general rule of thumb? Like, I would always consider like a certain percentage.
A general rule of thumb is probably 10%.
Okay.
But it's interesting because I say just start, right?
Yeah. Yeah.
Do 100 a month, see how it feels. And every 3 months, if you don't feel it, bump it up again.
Ooh.
So
So you need to feel the pain a little bit.
yeah, yeah. So like with clients that have 401ks through like Nike or Intel or some of these other bigger 401s, I will have them start at 10. And then if they don't really feel it, we go to 11 a few months later. And again, 12. And we just keep amping it up every few months until they're like, ooh, okay, this is good. I'm kind of feeling this.
Yeah. Yeah.
So just starting with 50 bucks a month. Most companies have a minimum of 50 a month. I'm not going to say most companies, most normal companies. I'm not
Okay.
talking about the big giant powerhouse
Yeah. Yeah.
names that you see on TV.
Mm-hmm.
They won't even touch you unless you have a $500,000.
Mm.
So a regular, normal, down to earth company
Good old
like what
fashioned,
we
yeah.
do,
Everyday business. Yeah.
right? We help everybody.
Yeah.
Will 50 a month is usually the minimum to get something started, or a lump sum of $3,000.
Okay. Okay. That's a
And
good
it
rule of thumb.
and it honestly doesn't matter what you put it in. Like work with an advisor to figure
Mhm.
out should I do a Roth or a traditional or a simple or a SEP, right?
Yeah.
Or maybe I don't want to tie it up till I'm 60. Let's do just a regular mutual fund and try to build some money first
Mm.
for that down payment on a house someday or
Yeah.
whatever it might be. Um, Even if you make the wrong decision initially, I still go in and fix those. I still have people who are retiring who were with a different company that had above average fees, and we
Yeah.
were able to cut them down significantly.
Mm.
And we're all in the business and we're going to get paid something. So nothing is free. Let me put
Right.
that out there. But even if they didn't do it right initially the first time, we can fix it. We can adjust it. We can change the fund.
Mhm.
We can change a company. Like, it really, to me, it doesn't matter where it goes, just get it going.
Yeah. Yeah. That's great advice. Okay. So creating wealth, like we hear about that a lot. I feel like it's one of those buzzwords right now, but have you seen some ways that people have gotten creative, or do you have advice on creative ways that you could build wealth? Because when I think of wealth, I think of diversification, or I think about ways of, short term, long term. You said even midterm. I didn't even know that was a thing. It was like short, mid, long. Okay. So what advice do you have for that?
So there are certain products that are good for the short term, right? And they usually don't have a lot of any fees or anything like that. And they're also not going to pay you very much.
Okay.
So like right now we have a money market with Invesco,
Hmm.
that which is a large investment company, and they are paying like 4.4%, which is great, right?
Yeah.
It's going to be better than what the banks offer. Intermediate would be something. So let's say that's a 5 year goal,
Hmm.
5 to 20, 5 to 30, whatever that time
Yeah.
frame is. Maybe it's a 5 to 10 year goal to buy a house someday, or own your own salon. That would be where I would do mutual funds because
Yeah.
you can just start socking it away. It will accumulate money, it will compound interest over that time, but you don't have to be 59 and a half to touch it like you do with all the other retirement accounts. So
Oh,
there are age limits of when you can touch those IRAs.
okay.
And that's why I call it the intermediate bubble, because there has to be something there for college savings if you want to send your kids to college,
Right.
or buying a house, or buying a second house, or getting married, or I mean, there's so many
Yeah.
different things you can use it for. But there's no limitations on how to act, like that you can't access the money. So that's why I like that intermediate bubble or time frame.
Okay.
And then long term is, I'm talking like you won't touch it till 59 and a half. So if you see someone who's 18, 19, 20, and they're like, hey, I would love to start a Roth IRA and put $100 a month in, I verify with them, like, hey, you cannot touch this
Yeah, right.
till 59 and a half. And,
And there's
and
penalties,
there are
right?
penalties
Yeah.
if you do. Yes.
What are the penalties?
IRS charges a 10% penalty on anything taken prior to that age.
Oh, okay.
Yeah.
Yeah, I think that's great advice, but I also think it's so important to just be like, set it and forget it,
Hmm.
pretend it never happened, it never existed.
Yeah.
Because so I understand that a Roth IRA, the importance of it is that it's you put it in and you've already paid the taxes previously, and then when you pull it out, it's you've already paid the taxes, so you're not being charged taxes on that. Versus
Right.
other investment vehicles, you have to pay the tax or pay taxes when you pull the money out.
Right.
Are there any other options for? I'm not saying it right. Are there any other options for pre-tax investments?
No. Depending on what you do for a
What
living.
about annuities? You were telling me
Yes.
about annuities last time.
Yes. That was where I was going to go. So,
Okay.
pre-tax wise, it's got to be that retirement plan, whether you're working for someone or for yourself. Those are all pre-tax. Um, The Roth IRA is amazing for tax-free later. In the middle, so the only reason I really bring up annuities,
Yeah.
is because, and it's kind of been a big bad word for a while, but
Yeah.
that's because the fee structures on them were huge, 2,
Mm.
3% for decades. And they've made them a lot better. So for someone that maxes out their retirement plan
Hmm.
through work and whatever that might be, then, and they don't want to pay taxes on the growth every year, that's where an annuity fits.
Okay.
So I'll have someone who maxes out their retirement, paid off their house,
Hmm.
the 4,000 a month they were paying towards that mortgage. They said, I need to do something with it and pretend I'm not getting it anymore still.
Yeah.
So we dump in 4,000 a month into an annuity because they don't have to pay taxes on it until they pull it out later.
I
And
see.
there's no age limit like IRAs where you have to take it. Right now it's 73. You have to start taking income on an IRA.
Hmm.
With an annuity or a Roth, there's no age limit. So you
Oh,
could actually be
okay.
80 before you, if you wanted to wait
Yeah.
until then to touch it and let it just keep building and growing. And
And you could
that's how legacies are built long term, right? For passing it down to
to your
generational wealth.
kids. Yeah.
hmm
Do your kids get taxed on it when it's just when they pull it out?
Right. When you
Okay.
pull it out, it's it's basically the income or the growth of it is taxed first.
Hmm.
And so there will be a point if you start depleting it that you won't have taxes. Like you'll never pay taxes on the amount you put in initially.
Yeah. Interesting.
Yeah.
Okay.
But it's a nice way to build wealth without having to pay capital gains taxes every year and having a
Hmm.
1099, which is a tax form you're going to get because you had too much growth in an account that wasn't tax deferred. So you have to pay taxes on that each year if you earn over a certain amount or dividends or
Oh.
capital gains or yeah.
So that's why you want a little bit of a buffet of a little sprinkling
Short
of
term, intermediate, long term annuity. Like
yeah.
yeah, there's there's
Oh,
a whole gamut of things that we can show clients to build wealth.
so many times creatives say that I'm just not good with numbers. And I've said that many times before too. And I mean, I think one of the things getting around that is just arming yourself with knowledge and instead of being afraid of it. But what are some, like, I think this is more of a mindset thing. We kind of talked about this in the very beginning, but how do you help people that they have a hard time with numbers and but they have to have it make sense? It's like that light bulb moment. Like one of the things I heard you say was giving them the big final end result goal and then helping them work backwards from there. That could be one of them. Is
Yes.
there anything else that you talk to people about, like that they just are not grasping the big picture or they feel overwhelmed by numbers and so then they kind of want to avoid it?
I will say that is one of the biggest compliments that I get from the people I work with because they say I actually understand what you're saying.
Mm.
Sometimes it's in the delivery.
Yeah.
And there are a ton of advisors out there who want to talk big, sound big, talk over your head. I can't stand that.
I can't stand that either.
Oh, and they make
Yeah,
you feel
they
inferior.
do.
I will not be that way, by the way. I joke with my clients is I can't even talk over your head. So, um, but it's really this is why you hire an advisor
Yeah.
because we do know numbers
Hmm.
and we have multiple people on our team that do exactly what I do, so they can show that and draw it out on even on a piece of paper to say, here's the goal. Let's work it backwards. Here's how much you need to save. And
Yeah.
maybe we can't do it right now, but in 3 years when this debt is paid off, then we can start amping it up, right? And then
Yeah.
we come up with a financial plan to help them get to that goal. And not everyone's going to hit that goal, but I mean, that's kind of it, it's, to me, it's the best way is just to have that trust or that relationship with somebody and let them be the numbers person. But as long as you understand it, that's what's important to us.
Well, and it sounds like it's just very customizable depending on the person's goal, where they are. There's just too many things. You can't have this blanket statement where somebody gives you advice on one thing and it's like it's not
Right.
applicable. So that's the reason, that's the whole point for an advisor. That's the reason why people come to us to get their hair done and they're not doing it in their kitchen at home. It's like there's a need for people and to lean on those people that can help you through that, have it make sense for you. And then I guess don't be afraid to ask questions, you know?
Yeah.
Yeah.
Like the first thing that we do when we meet someone is we ask them about their goals.
Mm.
What are your top 3 goals that you want to work on to start with? And it should be goal focused. If you walk into an office and someone's like, "Oh, here's the hottest 5 stocks of the day," you will run away.
Run,
They don't
run
care
for your
about
life.
your goals. But it has to be goal focused and tailored to you, and not all the companies out there do that.
I wanted to ask also about high yield savings accounts. What are your thoughts on high yield savings accounts? Do you think that that is worth investing money in, or, because I know that it's like more of a liquid and it's helpful for people. Do you give advice to people on investing in a high yield savings account, or is it not as important?
High yield savings or high yield bonds?
High yield savings account. I don't even
Okay.
know what high yield bonds are.
Okay. Just wanted to verify.
Okay.
They're very different,
Oh.
and way more aggressive. So, high yield savings, that's what I would call a money market. It's not a mutual fund, it's a money market. And like I mentioned, Invesco has one that's paying 4.44% right now. And that the thing is, those change month to
All
month.
the time. Yeah.
So it could be 4.4 now, and next month it'll be 3.8. We work with Invesco. I have my own Vanguard money market that we just moved money from Ally because Ally moved down to like 3.8.
Yeah.
And Vanguard is like 4.59 or something right now.
Oh.
So in most cases, there's not going to be any fees or charges or penalties if you liquidate it. CDs have penalties if you liquidate them, and they also don't, a lot of them really don't pay as that much compared to the high yield money markets. So
Yeah.
it just depends. And as interest rates change, all of those numbers are going to change too. But I do think it's a wise decision. And that's kind of my money market over here for emergencies that I don't want to touch, right? It has to be a big event for me to go in there and use that money.
Oh, I see.
That's your 5-year bucket.
Okay. Okay. That's good to know. So I have one last question about like the difference between a person and as an individual and their business. So if you take my scenario, so I'm coming to you for free advice. Like I'm in this new situation now where like you're in my studio. It's just me, myself, and I for now. And if I wanted to separate myself from the business and I'm paying myself through the business, I'm just taking like a draw, let's say. Is the business able to invest as well? Can you take the funds from the business and invest it into something?
Yes.
Okay.
Like we have a corporation.
Yeah.
So we have corporate accounts, and you can then go and invest in any money market or whatever with those corporate accounts.
Okay.
You could set up a mutual fund in the name of the business.
Yes.
Right. And grow that. But a lot of times with a business expense or a business account, that's money that might have to be used for the business. So I'd still would consider that like a 5-year bucket.
Okay.
I don't know if I would just go dump all of my money for my business in a mutual fund because that's going to fluctuate. And what happens if you need it and it's down 10%? Right.
Yeah. Yeah.
So it's got to be money for like 5+ year.
Yeah. Your
bucket.
Reserves that you just know you haven't touched for a long time.
Right.
Okay. That makes sense. So where can we find more about you? I think this is something that, because I know that you can help anybody in any part of the country, like you were saying that. And I know that you're not necessarily taking as many clients because you're so full, but you've got a team behind you.
I do.
So
There's 4 of us, 4 financial advisors on our team. My email is carrie.scott@ceterainvestors.com. We'll put that in the memo or link.
I'll put it in the show notes for sure. Yeah.
And then scottwealthmanagement.com if you want to check out our website and everyone on our team. There's actually 4 advisors, but there's 7 of us total. So we have a full staff that help with paperwork and emails and all of that good stuff. But we also do webinars all the time, educational seminars.
Oh, that's something we need.
So you guys aren't ready for Social Security or Medicare, so you can skip those ones. But we have market outlooks to help understand the markets.
Yeah.
Even if you register or send me your emails, I can put you on a list and you can just always be invited to those things.
Cool.
Even someone that's not a client can be invited and just use it as a way to educate because we do a lot of different topics throughout the year.
Awesome. Carrie, thank you so much for hanging out and just giving so much advice and knowledge. Like you shared a lot today. I feel like I'm going to have to listen.
There's a lot more.
That will be for another time.
Right.
Thanks again, guys, for hanging out with us. And I want to continue to encourage you to dream big, set goals, take action. We'll see you next time.